Hey everybody, it's Randy McMullin with Amstar Mortgage. I wanted to give you my 2024 forecast for interest rates and home values. Last year we said that home values would go up about 3 to 5%. That turned out to be pretty close. We were in the 5 to 6% range. So I want to talk to you about what's going on this year. A couple of things you may not have heard of before. One of them called quantitative tightening. So what that is, if you remember, rates got back down to like 3, 2.5%, 3%, 3.25% for several years. Well, they didn't get there normally. They got there because as mortgage bonds were put on the market for sale, the government went out and the feds bought literally billions and hundreds of billions and $1 trillion worth of mortgage-backed bonds. So as they came on the market, they bought them. And that supply and demand really just took rates and just drove rates down. So they were kind of artificially low for a pretty extended period of time while the government was doing that. So now the government has trillions of dollars of bonds and T-bills on the books, and they're trying to offload those now, and that's called quantitative tightening. So they're selling billions and billions of dollars worth of bonds. In addition to the new bonds, they're taking the bonds they bought before, they're selling them back out. Now you've got a different situation where you don't have a lot of demand, you have the supply, and that's kind of holding rates up a little bit. And that's one reason why we are where we are, not the entire reason, but it's a big part of it. So we got quantitative tightening happening, and this is the tricky part. During an election year, the feds don't like to kind of rock the boat. So it's possible that they may ease that a little bit this year, and if they do, that will certainly be a stimulus or help rates come down just a little bit. Now, we talk about supply and demand, and I've said this for years, and it's the same thing. If you remember, from 2010 to 2020, we built the same number of homes that we built in the United States from 1960 to 1970. But we've got a lot more people in the United States, so it created a housing shortage of several million homes. Well, we can't build our way out of that really quickly, so we still have some real supply problems. There's 40% lower inventory available today than there is in a typical market. And the time on market for most homes that are in really good shape, it's pretty quick. Homes are still selling within a week or two of going on the market. The other part of it is demand. And, really affordability has come into play now. With interest rates going up, with home prices going up, it's affected the number of people that actually qualify for a loan. So that's diminished the demand. Now, we still have a lot of pent-up demand. Interestingly, I put out kind of an informal survey to people that had interest rates around 3 or 3.5%. And I asked them, what would it take for you? What rate would it take for you to be motivated to sell your current home and move into a new home? And surprisingly, the answers were not exactly what I was expecting. I thought, well, what if rates get down into the 5s? And surprisingly, a lot of people said, no, we need rates to get back down to the 4s. Well, what that tells me is that there's going to be a lot of pent-up demand for a while because a lot of these people are just not going to move. There's not going to be that supply going onto the market, and that's not going to help the supply and demand equation. So that's going to be good if you own a home. It's going to put pressure on the homes. Now, the other factor, obviously, is the economy and inflation. That's one of the big reasons why rates went up in the first place. So the feds have had that 2% target on their mind since they started, and they are very, very committed to getting to that 2% rate. I think that they're probably going to hit that towards the end of the year, partly because some of the measures of inflation lag a little bit. And one of the biggest components of the inflation that they measure is in housing. And surprisingly, it's not housing prices, it's rent prices that make up the biggest part of that. And rent prices have started just gradually tailoring off a little bit. And I think we'll see that come into play. We'll see the inflation numbers over the course of the year drop. That is going to help the interest rates. Now, the other thing obviously is, what about jobs and a soft landing? So far, they've done a really good job. We haven't had a real spike in unemployment. I do think that the unemployment rate is going to continue to rise, and I think we'll see that happen towards the second half of the year. And that's going to help a little bit. And will we have a soft landing? That's still out for debate, but looks like there's a better chance of a soft landing than we had maybe looking at this maybe 6 or 8 months ago. So what does all this add up to in terms of rate and in terms of appreciation for the coming year? So what I think we're going to see on appreciation in the Atlanta area, now it's different in different areas, and you might have an area that's got a little more, and there are going to be some areas that have a little less. But I think in general, we're going to see something in the range of 4 to 5% appreciation this year. And because of all the factors here that are, impacting quantitative tightening, the economy getting softer, inflation coming down, I do think with rates, we're going to see rates get down somewhere in the 5.75% range. And I think that we'll be there sometime towards the end of the year, maybe even the fall of the year. So that's my forecast. I think we're going to see about 4 or 5% appreciation and rates getting into the 5s. Now, if you have any questions, please don't hesitate to reach out to me. I'll be glad to answer any questions you have. Have a great day. This is Randy McMullin with Amstar Mortgage.